It's March 4th, Monday, and this is the video log that takes my 30,000 to a million. We're going to do a quick overlook of the portfolio, and then we're going to explain why it's a bad idea to be invested in triple X leverage funds. And I'm going to bring up two extreme examples to show you why. So quickly, not a very eventful day today. EXK was down 1.25%. Apple up 0.5%. Really nothing much going on. All the gains being offset by some losses, and it's reflected in the overall movement of the account. As you can see, it's down $100, virtually no movement. So, Newmont Mining had somewhat of good news. They decided to ignore the Barrick Gold bid for the company and just continue with the merger with Goldcorp, which is everyone pretty much virtually thinks is the right move. So some good news there. But it's very interesting that the mining sector is holding pretty strongly despite the recent big drops in the precious metals themselves, which is a very bullish sign. Usually the miners lead the price of the metals themselves, so that means that the miners are not expecting the metals to go into a free fall anytime soon. They're just thinking it's a correction in a bull market. Okay, so let's jump into it. Why shouldn't you be trading or investing really into the triple X leverage funds? Let's take a look at two extreme examples. One example is the JNUG, which is the daily junior gold miners bull triple X shares. All right, so this looks like very normal performance. It's about zero gain today, 0.5% down. Okay, 17% down over the last week. 45% up over the last 3 months. So if you were invested, in the last 3 months, you'd be doing all right. But the market's been pretty bullish. But if you pull it out to 5 years, look what happens. This junior miners bull in 2014 was trading as high as $671, right? And now it's trading at $9.83. So over a really long period of time, this will depreciate quite substantially, right? It's down 98.66%, this fund, because it seeks to replicate the daily performance, not a yearly performance. You can't replicate a yearly performance of the miners. So the only thing you can do is basically day trade for you. And these funds are at really big risk of what's called a beta decay. All right, beta decay. So if you buy something at $100 and it goes 20% up, it's now at $1. I'm sorry, let's say 50% up. It goes 50% up in a day. It's now it's worth $150. But now if it goes 50% in the other direction, the next day, it's now worth $75, right? It's not back to the original 100. So this process keeps happening, especially on very choppy, volatile markets, and the value of this fund decays. So, and if you don't believe me, this is the triple X bull, right? So what we're going to do is we're going to find the triple X bear and see if it's the inverse of this chart. So if this went down 98.66%, then of course the bear of the junior triple X fund must be up like a ton, right? Well, let's take a look. I think it's JTST. And let's see, in the daily performance, looks normal, up about 1/3%. Here's the 1 week, up 20%, and we should expect it to keep going up, right? However, look what happens with the 5-year chart. So if you bought this fund on October 31st in 2014, now you've lost 99.69% of your value. So if you had $27,616 in this fund, now you have 41.98. You have $42 if you invested 27,000. All right, just 4 or 5 years ago. So as you can see, they both decay really, really massively over the long run. So I wouldn't hold this for more than a week. even better not to hold it for more than a day. This is a trading instrument. It's not meant for investing. So if you're really bullish or bearish in a sector, make sure that you invest in a single, in a very accurately, in a fund that tracks the price of the sector accurately, and not a triple X or a double X fund. They all will go basically down to zero over the long period of time. So there's your warning. Here's your two examples. This is the bear, right? You can see it's lost 99.69%, and the bull, which has lost 98.66%. So they've both lost virtually all of their value. So please don't hold these for long periods of time. It's a warning. Don't do it. I wouldn't even touch them, even just for trading. Okay, you can leverage yourself in better ways than this, usually, but if someone is convinced that tomorrow the shares are going to go up a few percent, then fine, leverage up on this. But just know the risks and make sure that you're investing, pretty much knowing that there's a high probability that you're going to lose all your money if you do this. And that's my warning. That's my explanation for today. And I hope that I've saved some of you all some money. Now, I have nothing against the company that does this, and I'm sure that some pros are getting a lot of value of this. But if you don't fully understand it, I don't think it's worth trading. Anyways, hopefully tomorrow is a more eventful day than today. I haven't done any optional plays. I'm still keeping my money in the short-term notes, Apple, and a few hedges, and I'm still looking for an opportunity to make the next option play. So we'll see. Hopefully tomorrow gives me some opportunity or some food for thought that I can try to figure out the next trade. We gotta get to $1 million somehow, and sitting on my chair isn't, well, that's how I plan on doing it. By sitting in my chair, but being inactive is not gonna do it. So that's it for today. All right, peace out. Hope to see you all tomorrow.